Well, good afternoon, everyone. This is Cynthia Tomei with Interactive Brokers, and welcome to this afternoon's webinar on trading and hedging using the CME currency futures. Now, with us this afternoon, I'm very pleased to have Tim Morge of Blackthorn Capital, who will be doing the presentation. But to get us started, I would like to introduce Barbara Schmidt-Bailey with the CME. So, Barbara, if you could unmute your phone, give us a quick hello, and we'll go ahead and get underway.
Hello, everyone. This is Barbara Schmidt-Bailey at CME Group. Can you hear me okay?
Barbara, I'm hearing you just fine.
Okay. Well, we'll assume everyone is then. Well, thanks to everyone for joining us today. My name is Barbara Schmidt-Bailey with CME Group, and I welcome you to our presentation, Trading and Hedging with CME Currency Futures, with Tim Morge of MarketGeometry.com, which CME Group and Interactive Brokers are pleased to be sponsoring. CME Group presents trading opportunities across all asset classes, from equity indexes to FX, agriculture, interest rates, energies, and metals. Today's event focuses on CME Group FX futures contracts. CME Group offers the largest regulated foreign exchange marketplace in the world, providing trading of 49 futures and 32 options contracts based on 20 global currencies, including major world currencies and currencies of emerging markets. Our speaker today is Tim Morge. Tim has been a professional trader, author, and educator and mentor for more than 35 years. Besides trading his own capital, Tim is president of Blackthorn Capital, a private money management firm that works with several of the largest non-U.S. institutional portfolios. In the 1980s and 90s, he managed and taught other traders for institutions like J.P. Morgan and Goldman Sachs. Tim remains one of the world's largest currency traders, routinely carrying positions of several billion U.S. dollars. Tim has taught hundreds of professional floor traders at CBOT and CME to become successful off-floor electronic traders. He's the author of several highly regarded books, Trading with Median Lines and Mapping the Markets, featuring his own trading methods. Tim's websites, medianline.com and marketgeometry.com, feature a great deal of free information regarding his trading methodology, as well as a forum for traders. These sites are visited by thousands of traders from around the world on a regular basis. Tim is now also on the teaching staff for both University of Chicago and MIT, so we know that he is a busy man. So thanks, Tim, for making space for us in your schedule, and welcome.
Anytime you two ladies invite me, I'm there in a minute. I always have the most fun at these events. How's my sound there, Barbara? Am I okay?
You sound good. You could speak up a little bit more, though, Tim.
I'll get more excited.
Okay, that sounds good.
Okay, so I have the ball now. Let's see what we can do. There we go. All righty. Market Geometry is my main website. This is copyrighted 2010. Anytime we do anything with foreign exchange or futures or any financial instruments, we have to give a disclaimer. Obviously, Barbara gave us one from the CME. Interactive Brokers gave one earlier, I believe. Let me just give my short one. There is no Holy Grail. I don't have the Holy Grail. If that's what you came to see, I'm going to disappoint you. Trading is hard work. Some of it is drudgery. But that being said, the rewards can be great if you can master your tools and master yourself. And we're going to take a look at some techniques that can help you become more consistently profitable, especially if you work hard. And as I said, the hardest part, I think, is mastering yourself. So that's the end of my disclaimer. These are my results. It's my experience. Your experience may differ. And, of course, in volatile markets, who knows what can happen. So please be very careful. Don't over-leverage yourself, and be aware of the market conditions. So I'm going to vary a little bit. We're going to do a little bit more on hedging, but to be honest, this is going to run long as it is. So let me just point out that there's a new instrument that the CME has put together along with Dow called the Dow Dollar Index, sponsored by the CME Group, and I believe it's FND is the symbol, at least on Ensign and eSignal, and I think it's going to be a big winner. It's basically the G8 currencies weighted correctly, weighted much better than the dollar index on ICE, and I think long term you're going to see that the big boys are going to use this as a hedging hedging vehicle of the future. If you pull it up right now, you might see that the volume, the bars don't look particularly good, but it's only a month old. Give it 6 months. I think it's going to be a big, big, big winner. So, whenever we trade, we start out with blank charts. At least I do, and the people that I teach. And a simple line can be the start of everything. So we're going to start by showing you how to use simple lines combined with what I consider the 3 main important principles in trading: market structure, the current context of the market, and the frequency of price to find high probability trade entry setups. Now, once I show you how to identify a high probability trade entry, I'm going to show you how to evaluate its worthiness. How does it rank looking at money management and the potential risk-reward ratio? When I identify any high probability trade entry setups that also meet my stringent money management and risk-reward ratio requirements, I always enter my limit entry orders and initial stop-loss orders at the same time to limit my risk. Then I have to wait and see if the market allows me to enter. If my limit entry order gets filled, I'll then show you how I manage trades as a professional trader. And that's the key. You know, in market geometry, we want to do 2 things. We want to help people learn to be more consistently profitable, and second of all, how to trade and manage their trades as professional traders trade and manage their trades. So you'll soon learn that a realistic trading plan is really the key to consistently profitable trading. So let's begin this journey with a look at a chart, and today I'm going to choose the Australian dollar CME currency futures because it's been just so gorgeous to trade the last 6 to 8 months. 6 to 8 weeks. So here's a simple 20-minute bar chart of the Australian dollar CME currency futures. This is one of the G8 currencies I really enjoy trading. It has capital flows based on the huge amount of metals mined in Australia, so it trends quite a bit. And when the flows quiet down, it trades in very easy to define ranges. So you get easy trend trades and easy to define range trades. And if you like to trade both, you can trade both. If you can only trend trade, trade the trends. If you can only range trade, trade the ranges. But this currency, along with the Canadian dollar, has both on a regular basis. So a lot of people ignore these currencies, both of these currencies, especially these currency futures, and they're wonderful to trade, I think, especially for smaller traders. $10 a tick, you get plenty of movement. In fact, on a risk-adjusted basis, the Canadian dollar and the Australian dollar give you more movement per day than the E-mini S&Ps, which probably would shock most of you. So you have more trading opportunity based on the average true range in either one of these currencies than you do in the E-mini S&Ps. And you have a whole lot less competition for quality trade setups. So price is in an obvious uptrend here, making higher highs and higher lows. And throughout this presentation now, I'm going to ask you all questions. And now these are meant for you to ponder as I continue to walk you through the presentation. But please, you don't need to type in an answer. Just ponder the question. We're going to answer questions after we're done with the presentation because, to be honest, I have no idea how long the presentation will run. But we'll answer questions until either you run out of questions or Cynthia runs out of patience. I'll stay as long as you guys have good questions. So when I ask questions, think about it, ponder them, decide whether or not you want to ask at the end. Okay? Let's see what we have going. Now let's draw in one simple line. It's the magenta upsloping simple trend line. I'm not going to grab the low of the move, but instead I'm going to grab that first swing high and the second swing high, and I'm going to connect them with just a simple trend line. Anybody can draw a simple trend line. It's a straight line connecting 2 highs. Let's see my cursor. Can you see my cursor there, Barbara? Or?
Tim, if you grab the pointer that appears just above your slides in that annotation toolbar, we'll be able to see. There you go.
First swing high, second swing high. Thank you. I knew it was here, but I couldn't grab it before. There we go. So I connect this swing high and this swing high with a simple trend line. Anybody can draw a simple trend line, okay? Now this measures how far price climbed from its prior swing low, down here, up to the first swing high, so here to here, then from this low to this second high. It infers how much energy price has used to climb from the prior swing low to the current swing high. I think of these moves from a swing low to a swing high in an uptrend as the pulling back of a pendulum. So think of it kind of like this. Price is up here, it pulls back, it lets go, and it swings up. It lets go, and it swings up. Pendulum moves. The pendulum only carries a certain amount of energy for each swing. Now, I found that these first two swings in any uptrend or downtrend are usually the most efficient. So by connecting their highs in an uptrend, I've created what I call a line of maximum excursion. This simply means that though price may continue in the uptrend, it will likely have difficulty making a swing that climbs much past the sloped line of maximum excursion because every swing will probably be less efficient than these first two swings. Now here you can see price made 3 swings higher, 1, 2, 3, and then the line of force flattened. Here, this was the line of force before. You can see it was very steep. Now we flattened out here. Now that's normal. Price has expended a good deal of energy, so it rests. And after resting, price breaks out again to the upside, and once again makes new highs for the move. You can see we're closing our high here, and we're approaching the line of maximum excursion. There we go. Price runs out of energy as it approaches this line of maximum excursion. And note the smaller range bars in here. A sure sign price is restoring energy, and when finished, price will likely begin a more prolonged move. Which way will the prolonged move head? There's no need to guess. Let price show you, and then look for a new market structure to form before contemplating an entry. One piece of advice I give over and over to traders is this: slow down. Let price talk to you and tell you where it's headed. You don't always have to have a position just because you're sitting in front of the screen. Now, after consolidating, price gaps lower right here. You can see this open gap. And that gap becomes solid resistance. You can see price come back up with these small range bars and try and break back into the gap, but it just can't get back into this range. Then price begins to stair step lower. It finds brief support at the top of the prior range right here. And once it breaks below that support, it finds support at the bottom of that same range right down here at the multi-pivot line, which is a fancy name for a horizontal or sloped line that has multiple highs and lows touching it. You might want to note, by the way, look at each one of these ranges. They'll have about the same size or depth. And we often see that they stack and double and then quadruple, which is exactly what's going on here. Now we're making new lows, and we're breaking through this prior low. Price finally breaks below the multi-pivot line and continues to make new lows for the move, testing the last minor area of support found on the left side of the chart. When we draw on clean charts each day, one of our mantras is look left and be right, which reminds us to keep an eye on the prior swing highs, swing lows, and lines of support or resistance from the prior controlling swing or trend in mind. So if we think that price is moving and stair-stepping lower, we're going to pay attention to these prior bottoms, these prior tops, this prior bottom, this prior low, this prior low. Those are all areas where price might run into trouble as it stair-steps lower. Again, look left to be right. Now, where do you think price is heading? We've had a nice pullback after a long uptrend. Is it time to start thinking about long positions yet? Let me show you a simple visual concept I developed. Barbie didn't mention, I also teach 59 classes, 59 schools, classes of 4th and 5th graders in accelerated learning. I donate my time. I did 3 schools last year. I'm up to 59 this year. And I got involved because I have a 10-year-old and a 12-year-old. And nothing could honor me more than to be asked to do this. And I'll do more next year if I can. The states have pulled out their funding, so we're just our site is just doing it with the schools. And teaching them has been extremely valuable because they come to trading with no biases. They don't have to worry about paying the mortgage. It's basically, if you say A plus B equals C, they just follow it. So I hate to say this, I don't mean it in a negative way. They're almost like lab rats. If you give them a concept, they go with it, and they go with it with vigor. And they are just so much fun to work with, and to watch them just chew through these charts. Last year, in 3 months, non-annualized, they earned over 14%. They can only be long stocks, and this is when the stock market was going down. So they're quite good at it because they don't bring all the biases and all the junk that we get from all the advertisements and from CNBC and all that stuff. It's to them, it's just another exercise at school. So it's really very interesting. So this slide actually comes from the sessions that I teach. This is the very first week that I teach, and I call this crayon drawing. The sessions are taught over the internet, and I teach them a basic form of technical analysis I created, and again, it's called crayon drawing. It helps them visualize basic support and resistance, and also helps them project the likely targets of moves once they begin. And we'll use it in a minute. Now, the tools are simple: shapes and simple lines. We don't use any indicators. We don't use any math, just simple shapes and simple lines. We don't even use median lines. Simple trend lines, simple shapes. This slide is from their first day of crayon drawing school. Mountains and valleys are the shapes your eyes are easily drawn to. The bottom of the mountain is called a baseline, right here. And it often serves as support as well as a likely target once prices reach its likely top up here and then turn lower. So once we come up and reach our top and start to head lower, in the back of your mind, if you're crayon drawing, you should be going, well, where's the baseline? Right here. That's an easy target. It may or may not be support. If you manage to get short, it's certainly your target. Or you may be looking to get long if price acts correctly when it gets down to the baseline. So students look for mountains that have formed tops with uptrends on the left side and price trending lower towards the baseline. They can only be long stocks in this program, so they watch as price approaches the baseline. And if the baseline holds and they see signs of buyers, they look for a long entry. The opposite, of course, applies to valleys. Price comes down, starts to head back up. They expect it to come back up to the baseline or the rim where resistance may be. Certainly if they were long from down in this area, they'll be out before they get to the baseline. Once I teach them about mountains and valleys, my students came up with that name last year, by the way, I let them sift through as many stock charts as possible, looking for and marking these formations for the next few weeks. And believe me, once you understand them and find your first one, you'll see them all over the place. They may be simple visual tools, but they represent very powerful market structure. And yes, Barbara, we're going to try and get them into futures. Now, in an uptrend, on the left-hand side of the chart, over here, the baselines, or bottoms of the mountains, form solid support. So take a look. Here's our mountain. Price came down, tested the baseline, and held. Headed back higher. This is the pendulum. Formed a mountain, turned over, came down to the baseline, and held. Headed up, small baseline, turned lower, and held. Headed back up, 2 mountains, the baseline held. Headed back up, came down, the baseline held the first time. Now we got problems. Look at the right side of the chart. Once price failed just below the line of maximum exclusion, it turned lower, and the baselines were no longer, look at, they keep getting broken. They're no longer providing support. In fact, they were easily broken. This is a completely different behavior than price showed when it was in a solid uptrend. Has a change in behavior occurred? What do you think? Let's try a more traditional approach. This time using swing highs and swing lows. On the left-hand side, I mark out the swing highs and swing lows as price stair steps higher. And you can see we've got higher lows and higher highs all the way up. The baselines are holding, or the swing lows are holding is another way to say it. The swing highs keep getting broken. We go all the way up and make this major swing high. As price reaches its highest point, I add in a vertical magenta dotted line right here. I call that the pane of glass to remind me the trend may have changed. It's the highest high. Until it gets taken out, this is the left side, this is the right side. So when I talk about look left to be right, I'll be looking at this behavior and its swing highs and swing lows as this unfolds. Once you draw out the swing highs and lows in detail, as I have here, it's easy to see that the change in behavior has taken place. On the left side of the pane of glass, swing lows have acted as solid support, and on the right side of the pane of glass, swing highs are acting as solid resistance, and now the swing lows are easily broken. Now, though it may be early, I think a change in behavior has occurred. What do you think? Marking out these swing highs and swing lows is an easy exercise, and too few traders do it on a regular basis. Probably almost none of you. Being able to identify potential swing highs and lows as they form and are then confirmed will improve your trading dramatically. Practice, practice, practice. As I said, trading is hard work. Frequency. Now, I'm known throughout the world as the most knowledgeable teacher of median lines or pitchforks and action-reaction lines. I was one of Dr. Alan Andrews' original Inner Circle, the Coral Gables group, as a very young teenager. I'm sad to report there's only 10 of us left these days, and I'm the only active professional trader and educator left in the group. Now, I still use median lines as my main tool when I trade, but after teaching the thousands of professional traders at the exchanges, and now teaching people that want to become consistently profitable traders at my website, it became obvious there was something missing when teaching these students. People complained that they didn't know how to draw new pitchforks and which pivots to use, even though it was generally crystal clear to me. So obviously, I was missing something when I was teaching. Now, you know, it was the 4th and 5th graders that brought into focus what I was missing. If I had $1 for every time someone asked me when it was time to draw in a new pitchfork, I wouldn't have to trade for a living. And then I taught the 4th and 5th graders and consciously decided that I would distill charting to its simplest form because I have such limited time with them. In the end, I decided not to teach them about pitchforks. Instead, I focused on the visual aspect of human nature and tried to get them to identify repeatable shapes and lines. Then I taught them easy, simple, solid money management to use when trading these repeatable shapes or patterns. It became clear that there are 3 main layers to identify when first looking at a chart. The most important is market structure, swing highs, swing lows, mountains, valleys. Then context, is the market in an uptrend, downtrend, is it ranging, is it breaking out and starting to roll? And finally, frequency. With the professionals, I had begun by teaching frequency. But with the 4th and 5th graders, I focused first on market structure, then added context, things like trend and the pendulum pullbacks. Then I added frequency in the sense of simple trend lines. So take a look. Here's my first bit of frequency in this presentation. It's a simple trend line drawn off 2 major highs. Will it mean anything? Hey, lines are cheap. Let's see what it does. All right. Since I'm supposed to be the pitchfork guy, let's add one and see what it does for us. There's no magic here. I use the major swing high right here. This is the highest high. And then the swing low and the swing high from the first pendulum swing or pullback. So this major high, here's the pendulum pullback, here's the move back up. So here's pivot A, B, C. Median lines or pitchforks must always use alternating pivots. A high, a low, a high, or a low, a high, and a low set of pivots. Dr. Andrews found in his original work in the 1920s, that the relationship between the midpoint of the BC pivots, when connected with the A pivot, carried a mathematical relationship that carried forward once the C pivot could be identified. 80% of the time, price will then touch the median line once you can draw in This is the C pivot. Now looking at this particular median line, it shows us the probable path of price, a clear downtrend, and price has touched the median line. You can see it right here. We've gone to the median line, so it did its job. But the pitchfork hasn't really done much for us, in my opinion. Price is still in a downtrend, but I don't really like the way price intersects with the median line or its parallels. It's not giving me any easy trades. It's kind of messy. It is showing me the probable path, but that's about it. So frequency can be a useful thing, but often it just isn't enough. Let's keep in mind the current market structure in front of us, the context of the market. Remember, it was in a strong uptrend, and it may be in a strong downtrend, or this may be the pendulum pullback. I don't know yet, so I'm not ready to trade. Remember my earlier advice. Slow down. Just because you're sitting in front of your screen watching the market, you don't have to have a position. Trade when you have a very strong trade idea, a very strong idea of where price is headed, and a trade entry setup you recognize with quality money management, or simply wait. Quality trades will come along if you're patient. Now there are a handful of variations on traditional median lines, and on this chart I left the traditional median line in blue, and then I added a modified shift median line in orange. You draw modified shift median lines by moving the A pivot down by 50% and over by 50% from the B pivot. This median line variation was developed by Jeremy Schiff in the early 1970s to trade stocks that had lost 80 to 90% of their value. He was a metals trader, but one of his hobbies was picking up stocks at very low prices. But I found that this technique is very useful when trading currencies. When I draw a traditional median line, I find it shows me the likely path of price, but I don't like the way price is intersecting, or in this case, not intersecting, with the median line and its parallels. I immediately add in a modified shift median line. The modified shift median line uses the same alternating pivots, the same A, B, and C, and it has the same mathematical attributes as the traditional median line, but because its handle is displaced by 50% down and 50% over, it often gives more useful intersections with price. Okay, now I remove the traditional median line and add back the simple trend line drawn from the major swing high and the next major swing high right here, which comes right after the first pendulum pullback. So we pop down, here's our pendulum pullback. Simple trend line. Here's our modified shift. I left it up. There are two things to note here. Look at how well the lower median line parallel acted as support as it was tested over and over. Test, test, test. Acts very nicely as support. Yes, price is making new lows, but it's not making any progress below the lower parallel. Now look at the slope of the simple trend line drawn off the major swing high here and the next significant swing high. They pretty much match. The similar slopes give me more confidence in the frequency this modified shift line is carrying. For those of you scratching your head, Barbara, frequency refers to how price oscillates or moves around its general path of price. Barbara asked me this question earlier. Much like a sine wave moves up and down, yet still has a general direction it follows. Maybe we can come up with a better name, Barbara. Now, just to recap, I've marked out all the market structure. I've discussed the market context, and now I'm looking at frequency. This is how I analyze charts each day when I sit down to trade. Now, by the way, I don't leave the lines up at the end of the day. I generally start with a blank chart, unless it's a longer-term portfolio trade and the entry is still open. So now I add a traditional median line using the B pivot right down here as my first low, and pivots C and D, which are the next major swing, as my next two alternating pivots. It's immediately evident when the median line pops up that this pitchfork is not showing me anything useful. Why? Well, price is all the way down here. And even when price was in this median line, really didn't do much for me. Now, some of you are saying, okay, why'd you draw it then? And sure, I can simply erase it. But out of curiosity, because I'm trading the currencies, I do something I generally do each time I draw a traditional median line. Using the same B, C, and D, I turn this traditional median line into a modified shift median line. Because this is a currency futures chart, and I know from over 40 years of charting that modified shift median lines often work better on currencies, I do this without thinking. And look what I find. The green upsloping traditional median line, when turned into a modified shift median line, carries the same slope or frequency as the first modified shift median line and the simple trend line drawn off the major swing high and the next significant swing high. I said this before. Lines are cheap. Draw them and see what you can see. You can easily erase them if they're useless, but the more you draw, the better your charting eyes will become. Now, I'm pretty confident I have a set of lines carrying the frequency of price now. Let's zoom out and pull our chair back away from the screen and give this chart a good long look. Let's get some perspective here. There's lots of things to take into account here. One, I added a line of maximum excursion to the downside right here. And I didn't connect it off the low. I connected it again off the first significant swing low, then the second significant swing low, and then projected it forward. It's showing just about the same thing our sets of modified shifts are showing. Price may be in a downtrend, but when you take the slope into consideration, it's at an area where it is having trouble making progress. It's spending more and more energy to make new lows. Two, I looked to the left, and I found two important multi-pivot lines here and off of these lows that may be potential support. They just may be. If the larger traders, and I call them whales, and by the way, I am a whale, have left limit buy orders around these multi-pivot lines, they'll become support. But we won't know until price has tested them. You can see price is testing the first one right now. Price just tested an area of confluence formed by the maximum excursion line and the first multi-pivot line, and by the way, also the lower parallel of the modified shifts. The support held this time, and price has rallied a bit, leaving multiple tops. Right here, you can see we got 4 tops. Fine musical group, just below a swing high. Where do you think price is headed? Price tested the line of maximum excursion several times, and it failed to break and hold below it. Remember, it bounced off the first horizontal multi-pivot line as well. I don't have it drawn in, but if I could draw a straight line, it goes right here. Tested it and held perfectly. Now price breaks above the prior swing high right here and the multiple tops. Here's our 4 tops right here. The valley rim, which is right here, doesn't hold, doesn't act as resistance, and you can see many traders got caught short. That last wide range bar right here is evidence of stop loss orders and buy stop orders being executed. People are forced to buy because they got caught short, or they're breakout buyers and they're buying because price is breaking above highs and they want to get long. Do you think we've seen a change in behavior? Where do you think price is headed now? When I'm not sure, I always do this. I push my chair back to my trading desk several feet, close my eyes for a few moments to clear my mind, then I reopen my eyes and focus on price. Now that I take a look with a clear head, I see frequency that matches new market structure. Do you see it? Remember, lines are cheap. I simply connect the second swing low that created the maximum excursion line to the recent spike high up here where people got stopped out, looking for context and then frequency. Now I teach that the interesting parts of charts are found at the extremes, here, 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 up in here. Show me a bar or bars that make me sit up and pay attention, and those bars usually mean it's time to focus and start hunting a trade. Do you see any context yet? Do you see the new frequency yet? If you don't, push your chair back, close your eyes for a moment, and then reopen them and take a fresh look. I'll wait for you. Go ahead. Now take a fresh look. Do you see it now? Remember, price stopped right at the multi-pivot line and then turned higher, taking out multiple tops right here and a prior swing high right here. Could there be limit buy orders resting down at this multi-pivot line by larger traders? Remember, lines are cheap. I copy the first green upsloping simple trend line here, and then I connect another simple trend line with the same slope to the low touching the multi-pivot line, which is also the low for the current move at the moment. Note that price tests the lower green upsloping simple trend line several times, and it's acting as solid support. Look at it get tested. Is this a simple pullback in a downtrend? Just a pendulum and a move back down. What's the context of the market now? Do you see a potential trade setup? Stop and think about it. Let's zoom out once more and see if we can clarify the context and market structure even further. Now, when I pull back further to take a peek at the major swing low for the move, all the way down here, the strength of the multi-pivot line becomes much more evident. Look at it get tested all the way in here. This line carries a lot. If you will, it bisects negative direction, positive direction. As long as we stay above it, we might have some positive, this is a technical term, juju, some positive movement. Now when I draw on a major traditional median line using all the major alternating pivots, this major low, this major high, and now this test of the multi-pivot line, I find that the frequency of my green upsloping simple trend lines match that of the larger blue upsloping traditional median line. Take a look. It's the same slope. And those lines have now been tested, and they have acted as solid support. So I have a lot more respect for them, if you will. You should be able to see the market structure, the context, and the frequency all come together here. And that's market geometry. Do you see a potential trade? Because the blue upsloping traditional median line, as well as the lower green upsloping simple trend line, have acted as solid support, I want to buy a retest of the blue lower parallel at 89.40. So I want to get long right down here. I'm framing this trade. My initial stop loss order will be below the first test of the lower parallel at 89.27, below these lows. This is the first test of this blue upsloping lower parallel right here. If I'm filled, my realistic profit target is set by three things. Traders have a lot of problems with this, so pay attention. One, the prior swing high, which I marked in with a dotted red line. There may be sellers up there. 2, the first green upsloping simple trend line. And look, price ran out of energy there the first time. This line has frequency. It may run out of energy at this line if it gets back to this line a second time. And 3, I have the magenta downsloping simple trend line. And it's extremely important because everybody can draw a simple trend line. So lots of people are going to have this line drawn in. So if you get long here, it's probably unrealistic to say, well, I'll just take my profit up here, even though median line theory says it's going to make it to the median line 80% of the time. Well, sometimes it doesn't. What's important is that you pick a realistic target that has good risk reward and take the money and put it in your trading account. Now, note that all 3 areas of potential resistance come in at around the same area. So I put my initial profit target just below this area of confluence at 89.84. So I'm risking 13 ticks to make a potential 44 ticks. That gives this trade a potential risk-reward ratio of 3.4 to 1, which is fine for an intraday trade. I personally don't like to take trades with a potential risk-reward ratio of 2.5 to 1 when I trade. Now, most traders either don't pay enough attention to their risk-reward ratios or they don't identify realistic profit targets when setting up the trades. We'll talk about that in a minute. I'm filled on my limit buy order at 89.40 during the next bar. I quickly check that my initial stop loss order is in the market, then put in my limit sell order, which is my profit order, at 89.84. Okay? After the next bar closes, I take a moment to refocus and then examine the market structure that's forming. There are now 3 higher lows in a row right here. This shows me that there are likely other buyers in this area. But I want price to roll. And by that, I mean I want price to start showing me some upside momentum. I'm long. It's making higher lows. Let's go, guys. Let's get moving. Where are the buyers? Higher highs and higher lows, and preferably a spike bar higher would indicate traders have begun to chase price higher. I want these traders that are coming late to the party to jump in and push price higher up in here towards my profit order. As this last bar closes right here, and you can see closes on its high, I do one last thing. I run my cursor all the way up. I take a look at the resistance, the simple green trend line, and see the price will intersect with it at 88.96. So I adjust my profit target to that price. I'll change it every bar if I have to. There's not much room to go much higher than this, but if price should spike higher, I want every tick I can milk out of this trade. Here you go. I get my spike higher as the next bar unfolds right here. I'll leave my cursor right here because this is important. As soon as that bar closes, I cancel my initial stop loss order and I move my order to a break-even stop. Price is more than halfway to my profit target, so I cannot let this trade turn into a loser now. Price nearly hits my profit target right here, and then it slows down and congests. After several bars, I measure where price will reach the nearest overhead resistance, which is now marked by the prior swing high and the downsloping magenta simple trend line. And I change my profit target to 89.88. So I've actually moved my profit target down. I don't want to get caught long if there are sellers up there. I want my money in my pocket. If price gets near the prior swing high, I want to lock in the profits. Finally, price spikes higher, filling my limit sell order at 89.88. I booked 48 ticks of profit without taking any heat on this trade. More important, and this is something you should all be thinking about, I've rolled forward the profits from this trade into my account, which means I've rolled forward enough to cover at least 2 losing trades in a row. Because I don't use ticks, I don't use stops in 20-minute charts greater than 20 ticks. I just look at 48 ticks, so I've covered at least the next 2 trades. They won't cost me anything. Thinking about your trading profits in this manner takes a great deal of pressure off your mind. My next 2 trades are free. I'm going to be playing with the market's money, or the house's money, as a better would say, although we're not betting. Now, here's a simple truth. Most traders do not trade with a plan. They see price move. They decide they've got to try to catch some profits in once they see it move. And you can see on this chart that many traders were trading without a plan. They got excited at the extreme, right up in here, and started to take out highs just when they thought price was gaining momentum. Now, instead, they ran into sellers in this area right around the prior swing high, which is just how I framed out the trade. Somewhere in here, I may run into trouble if I'm long because I might run into prior sellers. I had congestion over here. I had a swing high. If I can get this, I'll take my money and walk away. If it goes up here, that's okay with me. I'll have this. That's more than fine with me. Getting long at these levels up here meant that they had no market structure to hide their stops behind, so now they're forced to exit at the market if they weren't using cash-based stop loss orders. Now again, this wide range spike bar lower right here tells us the story. Most traders got excited at the highs, jumped in, and are now being stopped out at a loss. You'll see this over and over again. People get excited at the extremes, and they get stopped out. I framed my trade to be out well before price hit that bubble of excitement as it tested the prior swing high. I'm out. I've rolled forward 2 or more stops into my trading account, and now my head is clear. What do? I get up. I go get some cool green tea. I sit back down to take a fresh look at the chart. Then I try and refocus. I take a look at the market structure, the context, and the frequency. After a moment, they all come together for me. Guess what? I see another potential trade. Do you see it? The recent pendulum swing higher didn't damage the downtrend. So here's my pendulum swing higher. Price came up, pulled back, swung higher, it's coming back lower. Price stopped right where it should, right in this area. Yeah, I went by it a little bit, but close enough for jazz. This is the market. And especially, look, we're in the last week or 2 of August. Things get a little bit sloppy. People got a little bit excited. Maybe went past by 10 ticks or so, but it stopped at the right area, especially against the green upsloping line, which has really been golden. The current market structure, the current context, and the current frequency give me a simple trade idea. These are not long-term portfolio trades. These are hand-to-hand combat trades. You have to frame these trades to fit the current market structure, or you'll get caught without a chair where the music stops, and it's not a pleasant thing. I now think this was a simple pullback in a downtrend, so I want to take advantage of this if I can. So I want to sell a retest of the magenta downsloping simple trend line, this line right here, at 89.83. Price comes back up here, I want to get short. My initial stop loss order is at 89.98, above this prior high, where everybody got excited and got long. And if I'm right about this being a pullback, I expect price will fill the mountain. This is the first thing in my mind. This is what I teach the 4th and 5th graders. If I'm right, the mountain is formed and it's turned over, and we should head back down and fill this mountain. I might have some trouble with this lower median line parallel, but I still think we're now I think we're in a downtrend, and this is just a pullback. So I think it's likely we're at least going to fill this mountain. If it goes lower, I don't care. Let it go lower. I want my money here. because we stopped dead against this multi-pivot line. So give me my money just above it. If I get stop out, remember, I'm playing with the market's money. Framing each trade before entering is extremely important. If price lets me in and then the trade becomes profitable, I do not want to get excited as price gets near my profit order and make the mistake of changing my mind thinking, oh my God, this is the big one. I always want to plan the trade and trade the plan. This trade, I'm risking 15 ticks to make 60 ticks, which gives me a potential risk reward of 4 to 1. And because I made 48 ticks on the prior trade, rolling forward several stops, again, I'm trading with the market's money, so there's no pressure here. I can swing free. Okay, price fills my limit sell order at 89.83, right up in here, during the next bar. I immediately make sure my stop loss order is in the market. Then I enter a limit buy order at 89.23, just above this multi-pivot line. This is my profit target. When another bar closes, right here, I note that there are now 3 bars in a row, each with higher lows. Because I'm short, I want these lows to be broken with conviction to show me that there are fresh sellers in this market. I want price to show me the sellers and show me the sellers quick. I won't be moving my profit target this time because when I framed this trade, remember, I decided price may run into limit buy orders at the multi-pivot line as it fills the mountain, as well as the prior swing low at 89.20. So my profit target is going to remain at 89.23. That's how I framed this trade. I don't care what price does. I don't care where it goes. This is my profit target. Price spikes lower. Here we go again. Good. Breaking the 3 prior lows and briefly trading below the blue upsloping lower parallel. I like the spike lower, but I don't like the price close near its highs. The price closed all the way back up here. When the wide range bar was at its lows, I was about halfway to my profit target, so I cancel my initial stop loss order and move it to break even. It's possible, looking at the current chart, take a look. Maybe this is just a pendulum pullback. That price has finished its downside pendulum swing. So if it heads even higher from here, I want out at break even. I'm not willing to spend any money at all other than brokerage because maybe it's stair-stepping higher. I still think it's in a downtrend. I'm going to get it every opportunity. But at this point, because of this close, I'm going to go to break even because down here I was halfway home. Two bars later, price makes another extremely wide range bar. Take a look at it. And this one tests the multi-pivot line down here and fills my limit buy order at 89.23. Look where price stopped to the tick, right at the multi-pivot line. Most traders don't plan their trades and they get excited at the extremes. And I mean they try to trade in the direction of the extremes. Breakout traders are an example of this type of trading. I would rather have fewer high probability trades with quality stop loss orders hidden behind market structures rather than chase price. Now my advice to traders trying to be consistently profitable, slow down and wait for quality trade setups. Never ever chase price. You can't catch every swing and you don't have to have a position just because you're in front of your screen. Lines are cheap. Draw lots of them. Keep that thought of rolling forward profits as rolling forward future stop losses. This will take a great deal of pressure off of you, especially if you're trading with a smaller account. Last, pay attention to your potential risk-reward ratio and use realistic profit targets. How do you know if they're realistic? At the end of each month, you should be keeping statistics. Then compare your average potential risk-reward ratio with your actual average risk-reward ratio. If there's a great deal of difference between the two, the profit targets that you are choosing are probably not realistic. Cynthia and Barbara, I am ready for questions if there are any.
Okay, well, I'm going to jump back in here for a minute, Tim, because a few questions have come in, and I thought what I would do is give you an opportunity to read that chat panel. And then I'd also like to just simply put up a poll. It will be there for only about 30 seconds, everyone, and I do ask that you help me out with this poll. Actually, management requires me to run it, but that's because we do have the information, or we do try and give you information relevant to your trading needs. So if you like today's information, if you would please simply make your selections to those questions and then click the submit button. If you'd like to hear more from Tim, notice question number 2 has an input box where you can put any type of information within that box on any additional topics or information that you'd like to hear from us. I actually do review this on a weekly basis with management, and that helps us plan future events. So I do appreciate your input. Please click Submit Now, though. Poll's about to end, so thanks, everyone. Now, if there is any additional if I did end that poll a little too quickly, please keep in mind you can always send me your questions or comments to webinars@interactivebrokers.com. So thanks, everyone. You can simply close that chat panel using the minimized icon that's located to the right-hand side of the polling title bar. Now, for those of you, if the chat panel did collapse, simply double-click that title bar and it will expand again so that you can send us any of your questions. Now, I did see there was one question that came in a little bit earlier while you were discussing, Tim, and I think I sent that to all participants or all panelists. Let me go back up. Oh, can this be applied to spot Forex?
Absolutely. This can be applied to any, how's the way to say it? I'm trying to get my panel. There we go. This can be applied to any instrument, including things like Mexican debt, foreign exchange, futures, anything that you can chart. In fact, a couple months ago, we charted unemployment for the past 40 years on a monthly basis, and it charts like a dream. Absolutely works on anything, any time frame. It was developed in the 1920s by Alan Andrews and Roger Babson and George Marischal, and they made hundreds of millions of dollars, $450 million for the Kennedys, and each about $55 million apiece, trading the first 18 months of the crash. So yes, it works on anything. Cash foreign exchange, I use it all the time, as well as FX currency futures on the CME. If I have my choice, I obviously like FX currency futures because they're transparent and it's first in, first out, but you can trade it on anything. And I certainly trade it on cash foreign exchange. I'm a huge cash foreign exchange trader, billions of dollars. Any other questions? Did you enjoy it? I will say this, Barbara and Cynthia always give the greatest webinars. They're simple, they're easy. If there are any problems, it's generally the presenter like me. So.
Tim, are you seeing the question that came in from Al? When intraday trading, do you favor a particular time period to draw on?
I'm not seeing anything. Why is that? But, okay, what was it?
Oh, okay. When trading intraday, do you favor a particular time period?
Okay. It varies by instrument. In the currencies, I like to look at 20 minutes or 240 minutes, and the reason why is major hedge fund people look at 240 minutes, which is one half of the time frame in New York, and then so the first half of New York, then the second half of New York. Then it'll be the first half of Tokyo, the second half of Tokyo, then the first half of London, the second half of London, then back. And so if you divide it into a smaller time frame, you can look at 20s or 60s. I find the 60s are a little large for me, so I like 20s. You can also use, though, tick charts, but those you'll have to take by instrument and find one that, and I just call it charting pretty. For example, if you used 1,444 ticks per bar in the Aussie, you might find that it takes a long time to form a bar. So you might move all the way down to 377. If you're using the euro futures and you go to 377, you might find that that's too noisy. So you might have to back all the way back to 1444. You can use range bars, momentum bars. I don't like them personally because they hide a lot of market structure. I prefer tick bars, volume bars, or time-based bars. But you can use any of those. And I think really it's a personal preference. When I do one-on-one mentoring, one of the first things I do is go through the instruments that person is trading and what time frame they're using. And I spend a great deal of time going over their charts, trying to make sure that they're actually using the right time frame, because sometimes just a tweak in the time frame that they're using makes all the difference in the world.
Tim, if you're not seeing questions, would you drop the scroll bar over to the right?
All of a sudden, they're popped up.
Oh, excellent.
Would you like give it a little?
Just a little bit of kick in the pants.
Yeah, there you go.
There you go.
All right, so Irwin says, what's the approximate hit rate using this approach? Well, Irwin, I can answer that question, and I will answer you with this. I'll give you my statistics, but again, as I said at the beginning, my experience and the hit rate that I experience has no relation to what you're going to see, because A, I've been doing this for 40 years. You may be more qualified than me. You may have more experience, or you might be better at this even as a very inexperienced trader. Each trader is different. Depends on your ability to see the market. It depends on your ability to master this technology or this technique or methodology. It depends on your ability to chart. It depends on your ability to read the markets. Me, I'll tell you my lifetime statistics. I'm past my 40th year of trading over the entire thing. Now, this also includes portfolio trades. I'm at about 66% profitable, and my risk-reward ratio is a little bit over 3.6 to 1. That's all trades. I hope that works for you, Aaron. Mervyn Stein says, okay, here's a question about hedging. We were going to do hedging, but we didn't. And actually, we ended up with plenty of time. But how do I use hedging? Well, to be honest, IB, one of the really strong points of IB, and Cynthia, you correct me if I'm wrong, if I say this wrong. You could make a transaction to change the way your currency is held, so that it's not held in dollars, for example, held in euros, held in a basket, held in Canada, held in whatever you want. Very simply, anytime during the day, at the end of the day, you can have your profits flushed in. So you can change your home currency very easily. And that's a very, very important thing to some people, especially if you have a larger account. And I have several friends that trade with IB, and one of the reasons they are so hot on IB is because it's so easy to hedge. However, let's just stop and think about it. If you're sitting in the United States and you have a $100,000 portfolio, $100,000 in your account, and it's in dollars, and you don't want them in dollars, you can simply sell the dollars against the new FND index, which has just come out. Believe me, it will be liquid very, very soon. It's becoming more liquid every day. You'll now be hedged against the G7 of the G8 currencies. You'll be long those currencies in a weighted basket and short the dollar. Or you could say, hey, I want to be long Canada. I don't want to be long the U.S. I really like the Canadian dollar. Well, then take the amount in your account, and either, if you're with IB, you can wash it into Canada, or B, you can use futures and the micro FX futures and turn it into Canadian dollars just by selling that amount of dollars or buying that amount of currency futures and holding it as a hedge. Did I get that correct, Cynthia?
Absolutely. And one thing, though, I did want to mention I believe what you're talking about is the brand new FX index
Yes.
that's available on the CME. And for those of you who have joined us here today, that's actually the ticker symbol would be FXD that you enter into the platform. Right now, it's not yet tradable on IB. There's a little bit of complexity in getting those contracts set up for clearing and also for the account. So just be watching it. You can still watch the information. It's not quite available for trading. If you do want that available, note there is you can send those comments through our new features poll if you'd like to see it added. We do have it in progress, but I think if you do have any additional comments on it, that will help move it forward just a tad bit faster.
Everybody, please note that. Either send an email or note that on your comments, please. And the reason why is because IB is so effective and so large. When they join the party on their platform, the volume will triple on day one. So, Cynthia, drag them to the party.
Okay. Sounds like a plan, Tim.
Do we have any other questions?
Well, if there are any additional questions right now, I would like to invite everyone to, if you do have a question, please enter it into the chat panel and also make sure that you send it to all participants. I saw a couple of questions come through that went to all attendees, and the presenter cannot see that. Now, also, while you're thinking of any additional questions or while you're typing, I do want to let you know that today's event has been recorded. I know Tim covered a lot of information today, and if you'd like to come back and review this recording or review the playback, simply watch your email later on today. It normally takes me a couple of hours to compile and upload it to our servers, but just as soon as that recording becomes available, you'll all get access to it. So watch your email a little bit later. Also, for those of you who do, or as you're exiting the event today, I have included Tim's slides as webinar notes. It's a PDF copy that will pop up as you exit today's session. So if you'd like a copy of the slides, they will be available as you exit today's session as well as you exit that recording. So it looks like I delayed long enough so that Erwin was able to get his question in. Do you want to take that question, Tim?
Oh, I did that one. That approximate hit rate?
I'm sorry. That was for the IB team, and that would be me. When using so-called bracket orders, is the stop and stop profit orders really on the market, or are those waiting on an IB server? Well, Erwin, how you can tell is using our colored order status colors. Now, there's various colors. They're all listed within the user guide. Now, typically, when you do send those orders in as a part of a bracket, it's waiting for that parent order or that initial limit order to enter the market. Once those orders do enter, then you'll see those both the brackets or each side of that trade will then activate. Now, typically what is in the market is going to be your limit order, where if you do have a protective stop, that is held on IB servers until that stop price is reached, and then it's actually transmitted. So I believe that's what Erwin was looking for.
I have a question for you.
Okay.
When things slow down for both of us, hopefully this month, I believe you're going to do a go-to-meeting recording with me and go over the IB platform and teach stupid old me all the ins and outs of these orders, right? And how to check the audit trail and how to take a look at the OCOs, et cetera, et cetera. And then we're going to put it on our website, right?
Oh, excellent. Very definitely. Maybe not later this month, but I think we might have some time. Right, we may have some time to be able to do that in October. So let's look forward and we'll book that.
I have to tell you the truth. I thought it was October. I'm sorry. Oh, my God.
Time flies. Not quite that fast, but it is going by fast. All right. Well, I'm not seeing any additional questions come in right now. So, Yes, I do. Okay, Stoyan actually, and this has come into all attendees, no Andrew's Pitchforks on the IB platform. And no, we don't have the ability to add those pitchforks per se, but what you can do is use those trend lines to be able to draw it. Now, also, as Tim was showing you during today's presentation, those trend lines, when you want to create a parallel trend line, it's very easy within our charting package by simply right-clicking on the existing trend line. You'll find once you right-click there, a selection will be to create that parallel line, and then you can, once that parallel line is created, then you can click and drag it exactly where you want to position it. So try using some of the advice that Tim gave you today with those trend lines in the Trader Workstation real-time charting feature.
I've got another one for you. There's a member of Market Geometry, nicest guy in the world, and a wonderful programmer. He made a easy-to-use interface for looking at images as well as for platforms that don't have pitchforks on them. It's called Chart Overlay. The company's called Omnium Software. I'm not trying to sell anything, but you can put it right on the IB platform and draw fibs, anything you want is on there. It's easy. It's rolling off a log easy. It's cheaper than dirt, and it's an easy way to solve the problem. If you don't want to do the parallel line, do it this way. It's extremely easy to use, and I use it to look at images all the time.
Oh, beautiful. Well, Tim, would you send me his information? There's
Absolutely.
actually a bit of a process to join our education partners, but I'd be happy to forward that on to him and then actually get him listed on the IB site as well. And then we'll forward that information along to you so that you can also share with any of your participants.
Yeah, and I'm not trying to do an advertisement. It's just, you know what, when I saw, first of all, it's so easy to use, and second of all, it's so cheap, you can't amaze it. It's just somebody sends me an image in an email. You can just open it up and draw all you want and make notes and save it. Same thing on a platform. If you can't draw on your platform, knock yourself out.
Oh, excellent. Well, we'll get in touch outside of today's meeting so that we can get that information and get it up and post it on our site. And then next time Tim's back, we'll make sure that everyone gets access to that information.
Great.
So with that, I have to thank Barbara Schmidt-Bailey with the CME for coordinating today's event. And of course, as always, thank you so much, Tim. This has always been, these are well-attended events and also very interesting. So we do appreciate the time that you've spent with us this afternoon. So it looks like that is going to conclude our events today. Oh, just a moment. I see another one that did come into all attendees. One more chance before we let you off the hook, Tim. Earlier, you had talked about the AUD CME currency futures.
Yes, sir.
What other contracts do you suggest for smaller accounts not to overtrade? And that's coming from Andreas.
Andreas, I like the Canada as well, so 6C. I also like the electronic, this will crack you up. I like the electronic soy meal, believe it or not. Go to the CME page and look up electronic soy meal. You don't want to trade call on the phone brokerage. You want to trade the electronic, 95% of the volume is there. But intraday trading, it's a really interesting contract. And remember, because soybeans, what it is, it's part of the crush where they go from meal to soy oil back and forth, so it's got a flow. So it trends and then it ranges, and it's very much like a currency. It trades very much like a currency. And I start a lot of people out that have smaller accounts and are just learning how to trade on that as well. And it's the margin on it is quite small. So that's another very interesting one. I think those three are good. I wouldn't watch more than, if I were you, even if you're experienced, I wouldn't watch more than about 5 things. And the moment you start to pay attention to one chart and say, hey, I think I got something going here, I'd minimize all the other charts and not pay any attention at all until I was done with it. Either plays out into a trade or you go, okay, never mind. Then start hunting again. So focus on one thing. Don't try and juggle 2 or 3 balls. And I would add, I'd do 2 or 3 currencies, maybe a bond future or notes, and pick something else wild. I like I said, I like the soy mill. And I've had a lot of people that I've mentored as well as people that just come to the free site, try it out, and really find it actually quite interesting and easy to trade.
Super information. Thanks once again, Tim. Excellent. Well, that is going to bring us to the conclusion of today's webinar. As a reminder, watch your email for the playback if you'd like to come back and listen to those concepts over and over that Tim presented here today. So thank you all very much. Reminder, you can exit today's event by using the X in the upper right-hand corner of your screen. Thanks, everyone. Have a great night.
Cynthia and everybody else, thank you so much for taking the time today. I really appreciate it, and I hope you have a great evening.
Thank you, Tim.
Take care.